A man is standing in a grocery aisle, staring at pantyhose. He's not shopping, he's writing something down. No cart, no list, just him and this one brand. 3 weeks later, he puts $10 million behind that brand. He wasn't a shopper, he managed the largest mutual fund on earth. His name was Peter Lynch, and the way he found that pantyhose stock broke every rule on Wall Street. Because everyone else was looking somewhere completely different. On one side of the room, analysts, buried in spreadsheets and interest rate models. On the other side, Lynch, walking through a mall with his wife. In nature, information about a business travels slowly, guarded, expensive. But some information was sitting in plain sight the whole time. You've had this same edge your entire life and never used it. Every store you've walked into, every product you've actually used. Lynch didn't have a system. He had a Tuesday afternoon. In 1977, he took over a small, obscure fund called Magellan. It managed about $18 million. Barely anyone had heard of it. 13 years later, that fund managed $14 billion, an average annual return of roughly 29% for 13 straight years. No other mutual fund manager in history has matched that run. But the number isn't the interesting part. The interesting part is how he found the companies behind it. Because he wasn't looking at Wall Street. He was looking at you. At what you bought, what you liked, what you kept going back for. But that was only the surface. Lynch's actual research process started at home. His wife Carolyn came home one day raving about a new pantyhose brand. It was called Legs, sold in supermarkets, not department stores. No analyst on Wall Street had ever set foot in that aisle. Lynch went and looked for himself, and bought the stock behind it. That stock became one of his biggest winners. Then his kids started talking about a burrito place they loved, Taco Bell, a chain most of Wall Street had never eaten at. Lynch visited the stores himself, watched the lines, tasted the food. It became another 10-bagger in his portfolio. He coined that word himself, 10-bagger, a stock worth 10 times what you paid. He didn't need one of these, he needed a handful, found early. Dunkin' Donuts, same story. He liked the coffee before he liked the stock. By the time Wall Street noticed these companies, Lynch had already been in for years. He had a simple rule for it: invest in what you know, not what sounds smart, not what's trending, what you actually understand. But here's where it gets uncomfortable. If this edge was so obvious, why doesn't everyone use it? Because Wall Street doesn't want you to think it's this simple. An entire industry exists to make investing look complicated. Dense reports, confusing jargon, ratios only a specialist could explain. Not because the information needs to be that complicated, but because confusion keeps you paying someone else to explain it to you. Lynch himself said it plainly. Everyone has the brainpower to make money in stocks. Not everyone has the stomach. Meaning the obstacle was never intelligence, it was nerve, the ability to hold on when everyone else panics. But the deeper you look, the stranger this gets, because Lynch wasn't just picking good companies, he was exploiting a blind spot. Big institutions can only buy stocks that are already famous, already covered. Rules, committees, and reputations all push them toward the same handful of names, which meant small, unknown, ordinary companies were left completely unwatched. Nobody was covering Taco Bell. Nobody was covering Legs, which meant an ordinary investor paying attention could get there first. Lynch put it in writing over and over in his letters to shareholders. The person that turns over the most rocks wins the game. Not the smartest person, not the one with the best model, the one who actually looked. Now picture the room where this philosophy actually got tested. A conference room inside Fidelity sometime in the early 1980s. Analysts present their picks: chemical companies, defense contractors, complex mergers. Then Lynch speaks and mentions a stock nobody else in the room has heard of. A regional retailer. No headlines, no hype, just steady growing sales. He explains he found it because his daughter wouldn't stop shopping there. Some in the room laugh, quietly. It sounds too simple to be real research. But Lynch had already checked the numbers. The company was profitable, growing, undervalued. The observation was the starting point. The homework came after. That distinction mattered more than anything else he ever said. He wasn't telling people to buy blindly because they liked a store. He was telling them where to start looking, not where to stop. Most people who tried to copy him skipped that second part entirely. They heard, "Buy what you love," and stopped thinking right there. Lynch actually warned about this exact mistake by name. Never invest in an idea you can't illustrate with a crayon. Meaning, if you can't explain how the business actually makes money, don't buy it. Liking the product was never the whole strategy. It was just step one. This is where most amateur investors quietly lose money doing the Lynch method. They buy the coffee shop they love, skip the homework, and get burned. Lynch's real advantage wasn't the mall trip. It was what happened after. But this raises an uncomfortable question about the whole system. If ordinary attention plus real homework could beat professional fund managers, why does the entire finance industry still charge you for their expertise? Studies since Lynch's era have shown something uncomfortable for that industry. The majority of actively managed funds fail to beat a simple market index. Year after year, decade after decade. Most professionals underperform the market itself. Lynch was one of the rare exceptions, not the rule. Which means his real lesson was never, "You can beat Wall Street." It was, "Wall Street has no special advantage over your own two eyes." That's a very different, much quieter kind of claim. And it's the part that got lost as his fame grew. By the late 1980s, Peter Lynch wasn't just a fund manager anymore. He was a brand, a symbol, a guarantee printed on magazine covers. Money poured into Magellan simply because his name was attached to it. Which is, quietly, the exact opposite of what he'd been teaching all along. People stopped visiting malls and reading annual reports. They just handed their money to the guy who used to visit malls. The method became a shortcut for skipping the method entirely. In 1990, at the peak of his fame, Lynch did something nobody expected. He walked away. Retired from Magellan at 46 years old, still winning. He said he wanted to spend more time with his family, which sounds simple, almost too simple for a man this famous. But it lines up with everything he'd actually been saying the whole time. His edge was never Wall Street hours. It was ordinary life, closely observed. You can't observe ordinary life from inside a trading floor at 6 a.m. So when the job started eating the very thing that made him good at it, he simply stopped. No scandal, no collapse, just a quiet exit. Which brings us back to that grocery aisle where we started. You've stood in aisles like that. You've noticed things too. A coffee shop with a line out the door every single morning. A shoe brand your kids won't stop asking for. An app you check without thinking dozens of times a day. You noticed. You just never wrote it down. That's the actual gap between you and Peter Lynch. Not intelligence, not access, not some secret trading terminal. Just the habit of treating your own attention as information. Wall Street spent decades convincing you that wasn't enough, that you needed a degree, a terminal, a man in a suit to translate it for you. But the man who beat the market better than almost anyone said otherwise. He said, your job, your kids, your commute. They already showed you the answer. You just have to stop walking past it. This isn't a promise that you'll find the next 10-bagger tomorrow. Most people who try this will find nothing. That's normal. That's the game. Lynch himself said most of his ideas went nowhere. He just kept looking anyway. Rock after rock after rock. The odds were never the point. The habit was. Because habits compound the same way money does. A little attention, repeated for years, becomes something no analyst model can replicate. That's not a hack. That's not a shortcut. It's just patience, aimed correctly. Lynch didn't get rich by being smarter than everyone else on Wall Street. He got rich by refusing to stop being an ordinary person who paid attention. Somewhere between the mall, the kitchen table, and the fund's trading desk, he proved that the edge was never locked away behind Wall Street's doors. It was sitting on a shelf, in a supermarket aisle, the whole time. So the next time you notice something everyone else walks past, don't assume it's nothing just because it feels too simple. Write it down. Then go check the numbers, like he did. That's the whole method. Not a secret, not a system. Just attention followed through. Peter Lynch didn't beat Wall Street with a better formula. He beat it by trusting what was right in front of him. And somewhere out there, right now, something is right in front of you, too.